Now then, so the market's down. Headlines are screaming, people are panicking. And earlier last week, I bought more stocks. Welcome back to Dividend Growth UK. I'm David. If you're watching the news right now, you're probably seeing a lot of fear. Market volatility, geopolitical uncertainty, share prices dropping. But here's the thing. As a dividend investor, I don't really care about any of that. Now let me explain why I'm not worried and why I see market drops as opportunities, not disasters. First, let's talk about what I actually care about as a dividend investor. I don't care about share price movements day to day. I don't check my portfolio value every morning. And I don't panic when things drop 5 or 10 or more percent. Standard Life could drop 20% tomorrow. Legal in General could fall 15%. British American Tobacco could tank. As long as they keep selling their product and paying their dividends, I'm fine. Because here's the reality. I'm not selling. I'm not planning to sell Standard Life for 10, 15, 20 years. So what does it matter if the share price is down this week, this month, or even this year? What does matter is, are they still making money? Are they still generating cash? Are they still paying a dividend? If the answer is yes, yes, and yes, then a lower share price is actually a good thing for me because it means I can buy more shares at a cheaper price and get the same dividend income for less money. That's the dividend investor mindset. Share price is noise. Now let me show you some real data. I went back through the FTSE 100 over the last 5 years and pulled out every significant drop. Here's what I found. February the 11th to March 4th, 2022, the FTSE dropped over 8% in 3 weeks. What caused it? Russia invaded Ukraine, the biggest attack on a European state since World War II. Markets panicked. Then in June 2022, the FTSE dropped another 6% in 2 weeks. What caused it? Inflation fears, interest rate hikes, central banks tightening, everyone worried about recession. Then again later on, August 2022, the FTSE dropped another 9% over 2 months. Again, what caused it? Energy price crisis, cost of living crisis, inflation still running hot, more recession fears. Then in 2023, March, the FTSE dropped 7% in 2 weeks. What caused it? Silicon Valley Bank collapse on March 10th. Second largest bank failure in US history. Banking crisis fears everywhere. Then we move on to 2025. March 28th, the FTSE dropped 8% in 2 weeks. Again, what caused it? Market volatility. Profit taken after strong gains, no major crisis, just normal market movements. Now here's the important part. From April 11th, 2025 to February the 27th, 26, that's 10 months, the FTSE grew 37%, but it did recover, and it always has. So let's look at the pattern here. Every time there's a crisis, a war, a banking collapse, inflation spike, whatever, the market panics and crashes. The share prices dropped, sure, but the income kept flowing. So when prices drop 10, 15%, I'm not panicking. I'm looking to buy. I'm not buying huge amounts, maybe it's 500, maybe it's £1,000, just a tactical top up to take advantage of the lower price. And that's exactly what I did last week. So last week, I bought another £1,000 of Standard Life. Why? Standard Life dropped back to prices we last saw in June 2025, down about 12-15% from recent highs. I looked at the business, still profitable, still generating cash. Dividend yield now higher because the price is lower. Nothing fundamentally changed, the market just did what markets do. It fluctuated, so I bought more. Same company, same dividend, cheaper price. Now I'm not saying I'd never sell. There are things that would make me worry. Dividend cut or suspension. If a company cuts or suspends their dividend, that's a red flag. It means something fundamental is broken. One example was Vodafone. On May 14th, 2024, Vodafone announced a cut to their dividend by 50%. That dividend at the time was around 8-9%. I didn't sell at the time because even at 4% yield, I was still happy with that. Since then, the share prices grew over 40%. But last week, I decided to sell my holding in them, locking in that 40% profit. My only reason for selling was because Vodafone no longer fits into my ISA ethos. I'm aiming for 7% plus yield, and Vodafone was dragging that down. I also appreciate I have others that are doing the same in my portfolio, but I'm slowly rotating them out as and when I see fit. In the next video, I'll be back with more portfolio updates, deep dives. Now thank you very much for watching, and I'll see you in the next one. Bye bye now.